Welcome back to the Wall Street Podcast. Today, we're taking a deep dive into a recent JPMorgan Securities Plaque Research report.
Ah, yes, the one that just came out, August 12th, I believe. It's titled EU Oil and Gas Diesel Tightness Set to Persist. Quite a mouthful, but it basically flags Repsol for an upgrade and Equinor for a downgrade.
That's the one. And it really digs into the sustained tightness in European diesel markets, doesn't it? Looking at refining margins, stock recommendations, the whole picture for the European oil and gas sector.
Exactly. It's a thorough analysis.
So our mission today is pretty straightforward. Let's unpack these core findings. We'll look at the market dynamics, the company impacts, basically give you a clear, concise overview of JP Morgan's perspective on this key sector.
Sounds good. And the headline finding is stark. This diesel market tightness in Europe is probably sticking around into 2026.
Not just a temporary thing, then.
No, not at all. The report points to, well, critically low global stocks, for one. Plus, you've got accelerated refinery closures, over 800,000 barrels per day, shut down this year alone across Europe and the U.S. And there's the usual autumn maintenance coming up.
Right, and Europe's structural import need. That's a big factor, too.
Huge. Europe relies on imports for about 20% of its annual diesel demand. So the regional margins, they have to send a really strong price signal to pull in that supply. The forecast in the report is somewhere between $20 to $25 per barrel.
Okay, 2025, that's quite the premium needed. So let's zero in on the investment side JP Morgan talks about. First module, market dynamics. What's the absolute root cause of this current tightness in Europe?
Well, fundamentally, it's of the supply limitations. That's the core issue. European diesel inventories, they've really drawn down. We're talking the lower end of the typical 5-year range.
And why is that happening now?
It's a mix, really, a confluence of factors. You've got reduced imports coming in, especially from the Middle East after some of the geopolitical issues there. Then earlier this year, the price signals maybe weren't quite strong enough to attract sufficient supply. And interestingly, some of these major new global refineries everyone was watching, like Dangote in Nigeria, Dos Bocas in Mexico, their ramp-up has been, let's say, underwhelming so far.
Okay, so imports, pricing, and slower than hoped new capacity. Got it. That leads nicely into the regulatory side. Module 2, regulatory impact. How might this upcoming EU legislation on products refined from Russian crude shake things up further?
Yes, the potential ban effective January 2026. That's definitely a significant supply risk flagged in the report. Now, there are questions around implementation, how feasible it is, but the potential is there. If enforced strictly, it could put maybe 200,000 to 400,000 barrels per day of diesel imports at risk.
And where are those imports mainly coming from now?
Primarily India and Turkey. That volume represents something like 3% to 6% of total European demand. So it's not insignificant. Disrupting that flow would certainly tighten the market further.
Okay, a key factor to watch then. Module 3, stock implications. Given these market pressures, who wins and who, well, doesn't?
Right. So JP Morgan has actually bumped up their refining margin assumptions because of this outlook by about $1 per barrel for the rest of this year and into 2026. And the prime beneficiary they identify is Repsol.
Why Repsol specifically?
It comes down to their product slate. They have really strong leverage to diesel tightness because over half, more than 50% of their refinery output is middle distillates, like diesel. The sensitivity is quite high, too. The report estimates a 7% impact on their EPS for every $1 change in the refining margin.
7%, okay. Significant. And who's on the other side of that coin?
That would be Equinor. They actually get a downgrade to underweight. The reasoning is largely that their portfolio is much more biased towards upstream oil and gas production, so they have less direct exposure to these high refining margins for diesel. There are also some secondary concerns mentioned about their ability to re-gear, take on more debt, and potentially sustain competitive shareholder payouts.
Interesting contrast there between the integrated model and the upstream focus. So stepping back from the specific stocks, what does this mean for the general public, for you listening?
Well, the ripple effects could be quite tangible. Sustained high diesel margins often mean higher costs downstream.
You mean things like transportation?
Exactly. Think about the cost of trucking goods to supermarkets, running farm equipment, even public transport, potentially seeing fare pressures. These aren't just abstract numbers on a trading screen. They can filter down into the cost of goods and services.
So potentially influencing overall inflation and, daily expenses for everyone.
There's definitely a possibility that the report implicitly points towards.
This deep dive really highlights how interconnected everything is, doesn't it? Energy policy, global supply chains, refining margins.
Absolutely. And it all impacts the economic reality on the ground.
It certainly leaves us with a key question to ponder beyond just the immediate market signals. How will these kinds of structural shifts, this persistent tightness, ultimately reshape Europe's long-term energy security landscape?
That's the bigger picture question, isn't it? Something to keep a close eye on moving forward.